Hi, I'm Jeff Brumet, one of the co-managers of the Libero Dynamic Solutions and Cautious Portfolios. September was an incredibly volatile month in financial markets, and there were several key reasons for that. The Fed lowered interest rates by 50 basis points, which was a bit more than the markets were expecting. And what was, I think, even more important was they suggested an additional 50 basis points by the end of this year, and perhaps as much as another 100 basis points over the course of 2025. Along with the Fed cutting, the ECB also lowered rates by 25 basis points. That's their second reduction in rates this year. And they hinted also at further rate cuts to come. And the Bank of England, while they met in September, they did not lower rates, but suggested they were getting close to lowering rates. And just in the past 48 hours, the governor of the Bank of England has suggested not only will they be cutting rates, but they may in fact be aggressive in their pace of rate cutting. So what is behind all this, and why is this good for financial markets? Well, inflation has come down not quite to target, but pretty close to target in all three economic zones. And this allows the central banks to be less restrictive in monetary policy. So I would imagine, barring any sudden resumption of inflation going higher, you will see lower interest rates from the central banks over the next 6 to 12 months. This is an incredibly supportive feature for financial markets and for risk assets more broadly. And I think it helped equity markets recover in the back half of September.
Jeff's talked about the deficits with governments on the debt profile. And how do we deal with that? How do we deal with that concern? And the way we manage that is by having our portfolios focused with fixed interest towards the shorter end of the market. This way we are looking to protect ourselves from the eroding effects of inflation over the longer term. A 5% return fixed and guaranteed for 20 years sounds very attractive, but if inflation is running at 2–2.5% over the longer term, that's not really a positive return for you. This is the reason why in the cautious and in solutions we have the mix with the equity content there to provide real asset and real asset growth over the longer term.
China took some steps to try and stimulate activity. They cut interest rates in a variety of maturities. They cut interest rates on existing homeowners' mortgages. They also set up a fund to support the equity market. And perhaps most significantly and least publicized, you can now use Chinese listed equities as collateral to borrow money from the central bank. So basically they are allowing you to use margin to buy Chinese equities. So this produced an incredibly powerful rally in the last week of the month for Chinese equities.
The other areas we've seen a big impact is, as Jeff mentioned, the fiscal stimulus in China. And this has very much helped our allocation to the mining stocks, which again are key components of Chinese and the Chinese economy. China still makes literally most of the things that we have buy in the world, and therefore they need raw materials. So that's been a real positive impact for the portfolio in the latter part of the month.
So if you step back and look at the world, you now have the major central banks in Europe lowering rates. You now have China lowering rates and taking more steps to try and stimulate activity. You've had oil prices decline for the past 6 months. We've had a little rebound because of tension in the Mideast or renewed conflict there, and that may persist, but the benefits have already been felt in terms of lower energy prices for households and businesses. And you've got fiscal deficits all throughout the developed world, incredibly large at a time when growth is positive. And there is no prospect of any government significantly reducing the scale of their spending or raising taxes enough to narrow those deficits. So we've got stimulative monetary policy, stimulative fiscal policy, and we now have the second largest economy in the world trying to boost activity. This all adds up to a very positive environment, I would say, for risk assets, particularly for equities. I think also for commodities. It is more mixed on fixed income. The front ends of yield curves will obviously benefit from central bank rate cuts. But longer maturities have struggled even with these rate cuts because I think of concerns about fiscal deficits and the prospects for those getting larger. Let me take just a few quick moments to discuss the US election. It's now about 30 days away. It is a dead heat as far as the polling is concerned. I think what's important is that neither candidate is looking at addressing the US fiscal deficit. Former President Trump is talking about significant tax cuts, while Vice President Harris is talking about some tax cuts, some tax hikes, but generally more social spending. So there's going to be no reduction net in the size of the US fiscal deficit, no matter who wins in the White House. So I think it's important to realize that the fiscal stimulus is going to continue in whichever administration